Ever wondered about the investment strategy that made Warren Buffett one of the wealthiest people on Earth? A name synonymous with success, Buffett's acumen in the financial sphere is unparalleled. His strategy has been a topic of curiosity for many, from budding investors to seasoned professionals. Warren Buffett, often referred to as the Oracle of Omaha, is not just an investor, he's an institution. With a career spanning over 6 decades, his approach to investing has evolved, adapted, and yet remained fundamentally consistent. This consistency is the cornerstone of his success and the aspect that intrigues financial enthusiasts the most. In this video, we're going to delve deep into the world of Warren Buffett's investment strategy. We aim to offer a chronological overview, shedding light on the evolution of his approach over the years and the key factors that played pivotal roles in his journey. Now, let's journey back in time and start from the very beginning of Warren Buffett's illustrious investment career. Our journey begins in the early 1950s, as a young Warren Buffett takes his first steps into the world of investing. A fresh-faced graduate from the University of Nebraska, Buffett was eager to make his mark on the financial world. He was drawn to the stock market, a place where he believed he could apply his analytical skills and innate understanding of business. At this stage, Buffett's investment philosophy was still taking shape. It was during these formative years that he stumbled upon a book that would change his life, The Intelligent Investor by Benjamin Graham. This book, considered by many as the Bible of investing, introduced Buffett to the concept of value investing. Value investing, as Graham explained, is the art of buying stocks at less than their intrinsic value. It's about finding diamonds in the rough, companies that are undervalued by the market but have strong fundamentals. For Buffett, this idea was a revelation. It was a strategy that played to his strengths, his ability to analyze a company's financial health and future prospects. But there was more to Graham's philosophy than just value investing. He also stressed the importance of the margin of safety. This principle suggests that investors should only buy a stock when its market price is significantly lower than its intrinsic value. This way, even if their analysis is wrong, they have a buffer to protect them from significant loss. For Buffett, these concepts resonated deeply. He saw in them a sensible, disciplined approach to investing that reduced risk and maximized potential returns. He began to apply these principles, buying undervalued stocks with a significant margin of safety. His early successes validated his belief in Graham's philosophy. However, Buffett was not content with simply following someone else's strategy. He began to develop his own approach, tweaking and refining Graham's principles to suit his unique perspective and goals. He understood that investing was not a one-size-fits-all endeavor, and he was not afraid to chart his own path. This foundational knowledge set the stage for Buffett's future success, but his strategy was far from complete. As Buffett's career progressed, so did his investment strategy. Warren Buffett's investment philosophy has always been grounded in the principles of value investing. He learned from the master himself, Benjamin Graham, who is often referred to as the father of value investing. In the early days, Buffett was a strict adherent to Graham's approach, which focused on buying stocks that were significantly undervalued. This approach is often referred to as deep value investing. However, a significant shift in Buffett's investment philosophy occurred around the mid-1960s. This was largely due to his partnership with Charlie Munger. Munger, who would later become the vice chairman of Berkshire Hathaway, brought with him a different perspective on value investing. He believed in buying quality companies at reasonable prices, rather than looking for deeply undervalued stocks. Munger's philosophy resonated with Buffett. He began to see the merit in investing in businesses that, although not necessarily cheap, had great potential for long-term growth. These were businesses with strong competitive advantages, or what Buffett often refers to as economic moats. This shift in strategy was not without its critics. Many questioned whether Buffett was abandoning the principles of value investing that had brought him success in the past. However, Buffett believed that his evolved strategy was simply a more sophisticated interpretation of Graham's teachings. Over time, this shift in investment philosophy proved to be incredibly successful. Buffett's investments in companies like Coca-Cola and Apple, which were not traditional value stocks, have yielded extraordinary returns. It's worth noting that while Buffett's strategy evolved, his core principles remained the same. He always maintained a long-term perspective, and he always insisted on investing in businesses that he understood. This evolution in strategy proved to be a turning point in Buffett's career, leading to unprecedented success. By adapting his approach and embracing the idea of investing in quality companies at reasonable prices, Buffett was able to take his success to new heights. And in doing so, he solidified his position as one of the most successful investors of all time. The 1960s marked the beginning of the Berkshire Hathaway Era, a period that truly defined Warren Buffett's investment strategy. At the heart of this strategy was a simple philosophy: buy undervalued companies with strong competitive advantages, or as Buffett liked to call them, moats. These moats were not physical barriers, but metaphorical ones. They represented the unique advantages that set a company apart from the competition. This could be a strong brand, a robust supply chain, or a patented technology. Buffett believed that these moats were key to a company's ability to generate long-term profits. This philosophy was not just theoretical, it was translated into action as Buffett led Berkshire Hathaway on a journey of strategic acquisitions. Berkshire Hathaway, originally a struggling textile company, became the vehicle through which Buffett applied his investment strategy. Buffett's keen eye for value saw Berkshire Hathaway scoop up companies across a range of industries. From insurance giants like Geico to household names like See's Candies, these acquisitions were not just diverse, they were astute. Buffett targeted companies that were undervalued by the market, but had strong competitive advantages. In every acquisition, Buffett looked beyond the numbers. He sought out companies with solid management teams, strong brand reputations, and sustainable business models. These traits, he believed, were indicators of a company's ability to withstand economic downturns and emerge stronger. The strategy paid off. Berkshire Hathaway's portfolio of companies has consistently outperformed the market. The company's stock price has grown exponentially, turning modest investments into fortunes. But the real proof of Buffett's strategy lies not in the numbers, but in the companies themselves. Despite the diversity of Berkshire Hathaway's portfolio, each company shares one common trait: a strong competitive advantage that has allowed it to thrive in its respective market. The success of Berkshire Hathaway is a testament to the effectiveness of Buffett's evolved investment strategy. Now that we've taken a journey through Warren Buffett's investment career, what are the key takeaways from his legendary strategy? First and foremost, Buffett's strategy is steeped in the principles of value investing. This approach, pioneered by Benjamin Graham, focuses on identifying companies that are undervalued by the market. It's about seeking out bargains, finding diamonds in the rough, companies whose intrinsic value far surpasses their current market price. Buffett has famously compared this to buying a dollar for 50 cents. It's a strategy that requires patience, discipline, and a keen eye for value. Next, Buffett emphasizes the importance of buying quality companies at reasonable prices. In his own words, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This principle guides his investment decisions. He doesn't chase after the next hot stock or get swayed by market hype. Instead, he looks for companies with sound business models, strong management teams, and a proven track record of performance. These are companies that can weather economic downturns and emerge stronger, companies that are built to last. Then there's Buffett's focus on companies with strong competitive advantages, or economic moats as he calls them. These are characteristics that protect a company from competition, allowing it to earn above-average profits over a long period. This could be a strong brand, proprietary technology, or a dominant market position. Buffett believes that these moats can provide a company with a level of security and stability, making it a safer and potentially more profitable investment. In essence, Buffett's strategy is about diligence, patience, and a deep understanding of business fundamentals. It's not about quick wins or short-term gains. It's about long-term value creation, about investing in companies that can stand the test of time and deliver consistent returns. Warren Buffett's strategy has stood the test of time, earning him a place among the greatest investors in history. Warren Buffett's investment strategy is more than just a formula for wealth, it's a philosophy. This philosophy is deeply rooted in values that resonate far beyond the world of finance. Patience, discipline, and long-term thinking are not just hallmarks of Buffett's strategy, they are the bedrock of his success. Consider patience. In our fast-paced world, it's easy to get caught up in the rush. But Buffett's strategy reminds us that good things come to those who wait. Similarly, discipline is more than just a trait. It's a commitment to staying the course, even when the going gets tough. And let's not forget long-term thinking. It's about seeing beyond the immediate, about understanding that the future is shaped by decisions we make today. Buffett's philosophy encourages us to embrace these values, to apply them to our own investment journey. Remember, as Warren Buffett himself once said, investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. It's a game where the patient, disciplined person wins.